So I will start with introduction. So maybe I'll start to ladies first. So I'll start with Vivian. You introduce yourselves briefly.
Thank you, Hilda. Good morning, everyone. It's such a pleasure to be part of, the TOOLKIT and Incubator program. My name is Vivian Ombwayo. I'm a committee member at REIT and also a real estate consultant for more than 11 years. I am also a director. My position was a director of valuation and research at Broad Kenya. Thank you.
Yeah. Good morning, Changamuka. Yeah, I really needed to Changamuka. I was feeling a little bit cold. I am very happy to be here. My name is Tom Mulwa, and I'll take this opportunity to demystify some myth. I think some of my friends here have been asking, what does Tom do? We see him sometimes playing golf during the day at Karen Country Club. We also see him sometimes at CMA and at Hennessy. We also see him at Kenya National REIT. And we see him at IRA with the regulator. We see him at RBA with some pension people. We also see him in the hospitals. And sometimes we also see Tom at Haptak. So yes, I do wear many hats, but during the day I'm at Liaison Group. Liaison Group is a non-banking financial services organization across Africa. We have 4 businesses. We have an insurance business, we have a pension business, we have an healthcare business as well. But we have also got an investment advisory business, and that investment advisory business has decided to focus in 3 thematic areas, 3 thematic social impact areas, that is housing, education, and healthcare. So it's at least for those who've been asking whether I've got a day job, now you know. Thank you very much.
Good morning to all. My name is Francis Mwangi. It's a pleasure to be on the panel. And on the panel, I'm happy to see I have 2 good friends, one a former colleague and one a former neighbor. So I look forward to having a good, engaging session. As Zarova has said, it needs to be an honest conversation. So I work at a firm called Kestrel Capital. We're a stockbroking business here in Kenya. And we've done a number of transactions. We work closely with fund managers and owners of capital, both locally and international. So I think I suspect my role in the panel will be to provide good context and honest context of what money is looking for, be it for return and risk, because that's a critical conversation that we need to have to see how REITs should fit into portfolios. Again, this same conversation I was involved with a few weeks ago with venture capital firms who are also trying to see how do they tap into the local pool of capital. So I think it's a holistic conversation around what do owners of capital look for in terms of risk and return, and how do we package REITs to fit into that particular requirement that investors want. Thank you.
Good morning, everybody. Tumechangamka leo. My name is Lorna Wambui. I work at Standard Investment Bank. And, it's a pleasure to be on this panel. Coming in as a player in the intermediaries, as transaction advisors, and also a link to capital sources and the packaging of transactions. And I believe that will be a good conversation to have between having that position of being an in-between in looking at what capital owners would be looking at in terms of returns, and the packaging of on the other side of the transaction, so that it fits both ends of a transaction. So I'm glad to be here this morning and to have my fellow panelists, of whom some we've worked with in the past transactions, and looking forward to very engaging conversations on the table. Thank you.
Good morning. My name is Peter Waiyaki. I am a lawyer, partner with Mboya Wangongo and Waiyaki Advocates. We are a leading corporate and commercial law firm, completely passionate about capital markets, and in particular REITs. We were involved in the setting up of the first REIT, IREIT now. We continue to work with them to date. I should tell any lawyer in the room that a REIT is a good investment for a lawyer because the work never ends. They actually have work continuing. And I think if anybody from ILAM REIT will tell you that. And it really is a good investment for everybody. So I completely agree with Zorova when he says it's actually beneficial for every person in the room and the economy to be in that. I want to warn you of an event that is going to take place shortly. I will rise up and I will disappear. Because I had a hard stop for 11. It's nothing that anybody in the panel will have done, but I will go away. I hope I'll have answered a question or two before then. Thank you very much.
Good morning, everyone. My name is Cynthia Mbaru. I work at Dye & Blair Investment Bank, part of the corporate finance team. My work primarily is as a transaction advisor, so I think in terms of the panel, I'll be able to contribute in terms of what our role is, in terms of structuring the transaction. We also end up being a liaison between different regulators such as CMA, NSC, IRA, RBA. We also play a role in terms of coordinating the various advisors. One of the things you'll find out about REITs is that the advisory team is actually quite large because you now have legal advisors, tax advisors, valuers, structural engineers, and so on. So the transaction team tends to be quite large. I think for us, in terms of REITs, we're very happy to elaborate in terms of the process and timelines, and then also give our view in terms of, ideally as an issuer or a promoter, you might have an idea in terms of what you want to do when you come to market, but sometimes our role is really to marry that view with what the regulations are and what the investors actually want at the end of the day. But I'm happy to be here. Thank you so much.
Good morning to you all. I will not attempt to say that Swahili word. Coming from the mountain, something might come. So I'll have to try and learn it later on. So my name is Gikonyo Gitonga. I'm the managing director of Axis Real Estate. Axis Real Estate is a real estate professional services firm that has been in existence for the last 25 years. We actually celebrate 25 years in October. I'm one of the founding directors and shareholders. On top of that, I'm also serving as a director at the KPDA, Kenya Property Developers Association. There's a new terminology. I'm the chair emeritus of the Land and Physical Planning Sector Board at KEPSA, which I finished my 3 terms of 2 years 2 weeks ago, but I'm still involved in that. So I've been a practitioner in real estate as a property manager, estate agent. I don't do valuations, but my firm does valuations, but I have a good idea about valuations. So I'm happy to be here to discuss the journey on REITs, and I hope that we will be able to see more and more REITs come up. One time, 2 or 3 years ago, Hilda asked me, when are you retiring? So I just don't know. I hope it will be after 10 REITs have come into place. So after that, I will retire. Thank you.
All right. Thank you very much to all of you. So without further ado, I will think my first question will go to Peter Waiyaki from MWW. And really the questions are very open-ended. So we don't want you to tell us what we want to hear. We want you to tell us what can help us move forward, where can we start building our strategy from, and what can we, where you play in the ecosystem, what exactly should we be looking at in terms of challenges and opportunities. So feel free, and it's a very interactive session. So yeah, Peter, over to you.
I thought that was the introduction of the question. Was that the question?
Yes, it is a question. We really wanted this event to be very collaborative, and we did not want to ask specific questions that people want to hear. We know you've been in the background, you've been doing the work since the inception of REITs, so we want to actually really hear from you. So my question is very broad. It's really just to tell us, in terms of challenges and opportunities, how do you mitigate that from your where you play in your ecosystem, so that we can help us brainstorm and see where to plug in and what to do and to move forward.
True. Thank you very much. And I think I would want to start by just looking back at the setting up of the first REIT, and to say the rules came into place, I think, in 2013. But way back in 2009, we were already looking and advising clients who were looking into setting up some property ownership schemes. And it was very, very difficult. We were trying to go around the Limited Partnership Act and so on, which are not even as good as they are today. So people have always wanted some legally recognized scheme through which they could own property together with others, and through which they could realize some liquidity. So when we were working that background, and we were aware there had been a draft of REITs regulations, and they were taking very, very long to come to market, we could already tell there is actually pent-up demand. So when the regulations came, so I should actually say the Stanley REIT started way before the regulations, but the regulations came at the right time, took a bit of time to get them understood, get people to wrap their minds around them, eventually doing the REIT in 2015, going to 2016. Key challenge, obviously, is when a REIT is trying, a REIT in incorporation is trying to acquire property, and you are having to tell people, if we succeed in the licensing and the registration process and the capital raising, then we will buy your property. That is a difficult sell, because then they're saying, what if you don't in any one of those items? How committed are you? How do we know? And that's why it's easy for promoters who already have property. And there's an underlying assumption in the way the regulations were done that the person promoting the REIT would probably or most likely have property that they want to put in the REIT, like Hosea's organization, for example, which is not always the case. And I think therein lies the opportunity that you do not need to own a 50 by 50 to be the promoter of a REIT. Absolutely anybody in this room can actually be the promoter of a REIT. You don't need anything. You don't need money, you don't need land, you don't need a building. You just need to think and to structure. And we have structurers with us here. And then you need people who will put in their money and who are looking for a return. This is my statement. If it's profitable to own a building, even one house, then it's even more profitable to own it through a REIT for all the reasons that we were given. So I think we need to think outside. I must have buildings. The regulations allow that. You don't need. Stanley IREIT did not, ILAM IREIT now, did not own a single building beforehand. We were able to structure transactions that were conditional on succeeding on those items. Obviously, the promoter had to take a bit of risk, be able to reassure the potential sellers, and so on. And of course, we are aware that this REIT has since acquired some properties since registration. Because I may not be here for too long, let me just mention a few things that may be highlighted. One of the things we need to think about, and I want to thank CMA very much because of how flexible they have been, we do need to start thinking about collapsing the D and the I. They don't have to be separate. I think they can work together in partnership. I know Econ has tried to make it happen. It can be made to happen even more through the regulations. So perhaps CMA needs to be thinking about that. Should that be the next thing we are proposing in the next finance bill? No more about Finance Act. Now, the next thing is also to flesh out the concept which is already in the regulations about REIT schemes and REITs. Is there a difference? What is the difference? Can one help us achieve the other? Does a REIT scheme mean more than a REIT? Again, I'm not quite sure what the CMA interprets that as, but that's an area we need to explore, whether it can help us have a bigger scheme so that we also don't think that REITs are a one project item. Lastly, because of time for everybody, is the whole issue around education. I think what has slowed us down largely, and what we as a firm have been trying to work on, I know RAC has been trying to work on, I know KPD has been trying to work on, and I know the toolkit to help us work on, is the whole issue around education. Education is everybody's business. The only way we're going to realize all these things we say, the benefits of the REITs, is understanding the regulations, understanding the environment, then educating ourselves and educating others in workshops such as this, and many more. And we cannot wait for RAC to be arranging workshops to talk about REITs. Let's have partnerships between ourselves, fund managers, investment banks, lawyers, pension schemes, pension scheme associations, and so on, to talk to everybody who will listen about REITs so that they are well understood. I am very excited about 2031. I pray to God I'll be around to celebrate that 1.6 trillion. And because there have been capital gains, it should be way more above that. Thank you very much.
Oh, fantastic. Thank you very much, Mr. Waiyaki. And I really can attest to that in terms of investor education. I think when the first REIT came into the market, there was a lot of learning. And it was a very tall order, and it was not just even to the investors, but even to market stakeholders like all of us here. So I think that 10 years on, we still have a bit more to go, but I think this is a good step and initiative. So I'd like to go over to you, Gitonga, in terms of buildings, the market. What can you tell us in terms of where do we start? We've heard from Peter that we actually don't need to own buildings. We actually don't need to have a piece of land somewhere. And anybody can actually really be a REIT a promoter. So what can you tell us? Because of course we have to start with buildings. That's the underlying asset, property rather. So what can you tell us in terms of what you've seen over the years, in terms of old buildings, new buildings? How do we mix that, and how do we go around it? Yeah.
Thank you very much. When you call me Mr. Gitonga, I get scared. So just call me VG. Anyway, I think one thing about REITs, and when you're investing in REITs, is that the promoters need to have a proper business strategy. That's very important. To have, first of all, a clear business strategy. And that business strategy will then inform what I call the real estate strategy. And I think the biggest failure is sometimes you will have promoters or developers who are not very clear on what business they want to, what will their business strategy or the real estate strategy. When you look at real estate strategy, you've got to decide what is the asset class that you want to invest in. Are you investing in commercial buildings, industrial, hospitals, or residentials, or whatever? You've got to be clear, have understanding of that. Now, one thing that I have learned over years is that a lot of investors, everyone becomes a real estate expert, and they fail to undertake proper market research. And you will find somebody who will tell you, but you know, my father built a house, so even me, I know real estate. You know, it's just like the matatus industry. Everyone can own a matatu. Now, everyone can own a real estate. And I've dealt with many corporates who have invested in real estate and didn't have a clear strategy. And then they've had to change their strategy as they go about. Now, as we go, what's going to happen now is that you've got to start looking at things like sustainability. You've got to start looking at developing green buildings. What are you aware of what's going to, the new trends that is going to come, so that you don't make one investment and then it goes south. And that is why it's important to have that real estate consultant or advisor. And a lot of developers make the mistake of doing everything and developing and then bringing the property manager at the end. You need that real estate advisor to advise you, even in terms of during the time of acquiring, even if you're going to go at greenfield development, what type of development you're going to use, who are the architects, what are the building materials that you're going to use. Because building materials, they could have a long-term effect in terms of the maintenance of the building. And eventually, developers, when you're buying, know who are going to be your tenants. You find people who will develop, and they say, we build, the tenants will come. No, you've got to build to. So those are the things that we need to look at. There are quite a lot of things that you have to, and that's why you need the real estate advisor at the conceptualization of your strategy and as your part of your business plan. And I just want to urge you, the property manager is not just a rent collector. No. I know there was one time I was in a conference and he says that most of these property managers are rent collectors. If you're going to get a rent collector, then you're going the wrong way. But otherwise, just in the interest of time, I will stop it there and maybe questions will come later and we can answer that. Thanks.
Okay, thank you. Thank you, VG, for that. So let me just jump back to you, Peter, because I know you need to leave. In terms of what he's saying, you need to know who your tenants are beforehand. How is there any anything you can tell us about putting your documentation together? Because a lot of these real estate, I would say, developers may not necessarily have their house in order by the time they want to start a REIT. Let's say they have existing buildings, etc. So what can you tell us about that process? Because I know we went through a very rigorous process at the first REIT for Harry. So I just want you to give us a few thoughts on that, even as you're giving us your parting shot, and then we can proceed with the rest of the panel. Thank you.
Thank you. I think obviously when you talk about existing buildings, then you're going straight to an income REIT rather than a development REIT for now when the two are separated. So for one, no REIT is going to consider a building that is not properly occupied by rent-paying tenants who are performing well and who are on proper commercial leases, if it's a commercial building. We haven't had a REIT for residential, but I think it's time, and I know Jose is working on that. Same thing, properly occupied, meaning it's already been accepted in the market. In the IREIT, we are working with an 80% occupation with properly documented commercial leases. And that's just it. If people are not in your building, you can't put it in an IREIT. It just isn't possible. Remember, the people who are coming in are not coming to sort you out from your non-occupancy problems. They're coming because your building is attractive, it's built to standard, it's built according to the law, and it's actually occupied. That's the only way an IREIT will take it up. So I want to echo what VG has said, that it's not a shortcut. The REIT is not a shortcut, and you cannot find refuge for a bad building in a REIT. Already the requirements for the engineers to review it, for the valuers to review it, and all the other professionals, and the responsibilities taken and the warranties you're going to have to give disqualify a bad building. Having said that, your building doesn't have to be grade A. I was talking to some REIT operators in Nigeria, and they have the full range from really low class, can I say that? Low level occupancy, the sort of houses which are probably 2-bedroom only, not necessarily in an upmarket place, but they are attractive to tenants. They are tenants at that level, and they're well built. The fact that they are cheap doesn't mean they're badly built or that they are necessarily very small. And they have that whole thing from grade A office space right across the spectrum. They don't have to be overly expensive. They can be across the board. They can be it can be anywhere in the country, for example, provided there's proper title. Now that is the other thing, title. And when Zaroff was talking about owning property through REITs, that is the other huge advantage, because in Kenya we do have an issue with verification of title. Add to that what the Supreme Court said the other day about the title being not assured, and you want somebody who has paid somebody who is really good to look at that title. So when you're buying a 50 by 50 for $1 million shillings, would you not rather put that in a pre-due diligenced investment of liquid real estate. I don't think I want to say much more than that on that. Yeah.
Maybe parting shot, because as we wrap up with you.
Wow. My parting shot is we really must do this thing. We've been a bit slow. We've got 4 REITs, I think, in about 10 years, from 2013. We've got to do this thing. And we're counting on everybody in the room to get us to do this thing. Now, our law firm is open. We can work for you 24 hours a day to deliver to you the REIT structure. Well done. You've got to get a good lawyer in all these things. The things I'm talking about, the good lawyer, you need advisors, you need good real estate people. And we are available to help anybody who is even thinking about it. We'll work with you to even conceptualize and get the right advisors on board so that we make sure that you don't miss anything. Okay. Thank you. And thank you very much.
All right. Thank you very much, Peter. Now with that, I'd like to jump to, now that we've heard that you can actually set up a REIT, even, you don't have to have a grade A building or A++. You could easily have a grade B or a grade C building. Of course, you will get the tenant for that space. So I want to jump to Vivian in terms of the market. I know that, like Vijay said, that we usually, I guess we're a country where property is very emotive, and we don't necessarily sometimes rely on statistics and actual market data that tells us this is the way to go. These are the kind of investments you should be thinking about. This is maybe you can phase it, or this is depending on how the market is growing, this is where the direction you should be taking for sustainability purposes, because you're not setting up a REIT so that you can, unwind it at some point. It's something that is expected to be long term. So I know you've been in the industry for very many years doing feasibilities, market studies, and just giving us that insight of how that operates. So I just want to hear your thoughts on that in terms of REIT strategy, and even just for the benefit of this room, just to see where does that play in, and if we actually don't do that, what then happens? Because I know there are people who come back to you and tell you, oh, oops, we did this kind of investment, and now we are stuck. What can we do? Can we rejig it? Yeah, so over to you.
Thank you. That's. I think that's my main point. Was going to evolve around, because I like approaching things from the inception stage. So my thinking is that you have to get it right and get it right the first time, and that means at the preliminary stage, thinking about setting up the portfolio. And what goes into setting up a portfolio, there are a number of items. Number one is that you have to have understood the investment strategy of the REIT itself. Here in Kenya, I think we might say we've got 2 or maybe 3 types of REITs, including Sharia, but the main one is income and D-REIT. So when you're looking at income, what are you looking at if you're thinking of optimizing a portfolio? We're looking at maximizing returns, number one, and we're looking at minimizing cost. Okay, so when you're talking about maximizing returns for an IREIT, we're looking at rental growths and maximizing your rental yield. And if you're looking at cost, you have to strike that balance between cost and quality. So again, you need to understand who your target market is. And for you to understand your target market is that there's no way around it other than carrying out a market study. And market study here is just understanding the nuances of supply and demand. And supply, which of course informs your competition, is what is existing and what is in the pipeline. We have to remember to consider what is also coming into the market in the next couple of years. And demand here is not just what your target market requires, but are they able to afford it? So that's a very, very important aspect to look into. And when you're looking at D-REIT, because you're exiting the investment after delivery of the product, the other important aspect is capital growth or capital appreciation across the development period, and even what we call second-hand sale. Is the asset going to appreciate in value? Is it going to be more desired by investor purchasers and things like that? So maximizing returns. That it means maximizing your revenue, minimizing cost. The other aspect of it is, finding the optimal capital structure. For both REITs, you need to understand, how much is it that we can put in as debt. I know there are specific requirements by the legislations, and how much can we put in as equity and any other source of capital. I know Cynthia might, get into that. We've got mezzanine debt and the rest, but then how profitable is it? Do you have benchmarks? I'll get to my point regarding benchmarks as well. I feel like we need to sensitize ourselves. My previous colleagues have already mentioned it, is we are sensitizing in terms of, the consultants here. I'm very interested in educating the consultants in terms of benchmarks and standards. So benchmarks here, would mean that, I know this might be wishful thinking, but centralized database that most of us can have access to, and offer some sort of similar or regulated sort of results or advice, and that includes the entire aspect of prop tech, and also standardizing the quality, and standardizing not just the quality of the asset themselves, but the quality of the service from the service providers. I think we need to hone that, because speaking from a valuer point of view, we really haven't had standardized reports and things like that in regards to valuation of REITs generally. And valuation of REITs is very important, because that's what informs the unit price. I think I'll stop for there.
Yes, yes, those are very, very good insights, Vivian. I think you've mentioned a couple of things that are quite key, and I like the point you made on data, because every valuer you give to do a valuation of one building, they'll all more or less they'll give you different figures, and they'll have different valuation methods that they've used, but there's actually a standard of how to carry out valuations, whether it is a commercial building, residential, even an empty piece of land. There is a standard. So I think holding consultants accountable to that is quite key, because I think for assets that have not taken that into consideration, have actually suffered. So and that brings me to my next panelist. I believe there are 3 financiers here and investment bankers. So I want to hear from you, because you've heard about the challenges and the need for bringing REITs to market. So in terms of where you all sit, and this is to I think all of you, because I believe you're all from different companies, and you've been involved in the REIT transaction advisory process and structuring, and even being the advocates of getting investors to invest in this product, whether it's your high net worth individuals, financial institutions, and even retail investors. So it's quite an open-ended question, and we're all learning. So I'd really like to hear your thoughts based on what we've already had today. Yeah.
Let me go first.
Yeah.
So, first of all, I just want to say that Zoraba, you did justice to setting the stage for the conversation. The socio-economic value for REITs, it cannot be overemphasized. But from where I sit, we've got 3 basic challenges in my view. One is very simple. The administrative and the legislative challenges, those we can deal with. And Kili is a testimony that he could go to the regulator, and the regulator is very receptive, and they are very facilitative, and even our government, I've said before, bring it, we shall fix it as we go. So that's easy, and we can sit down as friends, as Kenyans, and we can get the legislative and the administrative issues sorted out. Yes, there are challenges, especially the tax breaks. Those could be really showstoppers, but we can deal with those. That's number one, in my view, which is a challenge, but it's a softer challenge. The second one, to me, is this thing which we call capital follows return. I think we need possibly to do a blood transfusion to ourselves, because Zoraba demonstrated in one of my favorite slides that the real value for it, you know, how the REIT as an instrument is a superior instrument, in my view, than all the other asset classes. But then how do we price, how do we value those extra intrinsic gains or values it demonstrated here, for example? How do you value, how do you price impact, for example? How do you put a price, a percentage price, B points on impact? How do you price the issue of that you've got, you can trade? How then do you value the issue of you've got an underlying asset? How then do you bridge the gap between the money market return of 16% and the value, the return of 12 or 10% on the REIT? So that we can start to talk to the fund managers and investors and to tell them that, look, it is 16, you're not comparing apple for apple here. You're happy to take away 10 against the 16 of tomorrow. And that is where the pain is. The moment we crack that thing, we're gonna have this fly. And I think that's a conversation we need to have with ourselves, because that's a challenge we are facing. They will always tell you, look, me, I saw it 16 yesterday on the IFB, so please hold on a minute. Let me enjoy this one as you think, as you sort out your toolkit.
So in terms of capital market space, where you primarily play, and more so on the sell side, I think I will let any one of you take up the question, but I would like to hear from each and every one of you, because I know one of you has been involved in the structuring process and the transaction advisory, and I know in the back end there are a lot of clients that you deal with who are looking for these investments. So are there any pitfalls that you're seeing? Are there any challenges, benefits, and even just to give us insights on how that other side of the market works? Because you know, developers on this are on the supply side, so you hold the demand card. So what can you tell us? So I think I'll leave it as that, so that can actually hear your views in terms of the investment part, capital market space, getting investors on board, and how does it really work? Not the generic answers, you know, we want the actual on the ground. Because when we come to market with REITs, they're like, there are no investors. They're not putting in any money. I know one of the things for Harry at the beginning, we actually had a target of 12B. But we actually did not hit that target. We actually hit about 3.6. Yeah. So of course you can see the appetite and the need to raise money and to get investors. But then what happens on the other side? What are you guys looking at? What are your clients looking at? And what can you tell this room in terms of how they can succeed in that space?
Tom has alluded to one of the greatest challenges, which is the return, the matching of cost of capital and the return. And that's a very broad challenge, because it's a factor of our macroeconomics. And maybe because we have players in government and other sectors, possibly that's a conversation we would be having about our macroeconomics. And because the capital chases the returns. And if the government is in the same market at giving a higher return than what we have in the capital markets, then that becomes a challenge in itself. And the other thing is the depth of our capital markets. As you've alluded, we've seen under subscription in our market, and I guess that is something as players we need to look at and see how we can broaden our market, and that is pegged more on information, because markets are also a factor of information. And what people get to hear out there is what attracts them into the market. So I think we need to be hard out there in terms of breaking it down, if it's about rates, what it is, what is expected in terms of returns. And the other thing now at the packaging side is the preparatory, because the package that comes is what the quality of it. It can't be fixed if the underlying property, as has already been alluded, the quality is not good. Then even if you bring it into the rate, then the attraction is not there. So the preparation part of it as transaction advisors is very important to make sure that everything is in place. The other issues, as Tom has alluded, there are issues that can be fixed in terms of regulation, because we feel as transaction advisors, the regulatory part of it is it's a complex product, and but that's something that discussions are already ongoing, and we have a regulator who is open to listen to the transaction advisors, and very responsive if let's say there's need for exemptions and all that. So I think the greatest issue is to look at our markets as a whole, to build this market so that there's depth, and we don't have we have a diverse players in the market, so that now we already have a demand for whichever product that comes into the market.
Okay.
Yeah,
all right. Thank you very much, Lorna, for that. So allow Cynthia to go. Yeah.
Sure. I think the reality on the ground is that real estate is a very emotive and personal asset class. People have their own views, and then most people have their small real estate projects somewhere. So when we go and market, say, a corporate bond vis-a-vis a real estate asset, they don't have any emotion towards a corporate bond. They're able to look at it objectively. But then sometimes when it comes to real estate, even if you're talking to a retail investor, high net worth, or even institution, they're like, why should I support your project whereas I have my own? And that's what people face when they go to the market. So to overcome that will take a bit of time. But I think sometimes now when you look at REITs, that's where if you have a REIT that now has landmark assets that people will not necessarily have, that's something that now becomes a bit more attractive to them. If you have a REIT that, say, owns like Sarit Center, owns like 10 buildings in Upper Hill, that now becomes like a sort of like a prestige or premium asset that they can say, now I own a share here. You'll walk into the building and say, look, I own 100 shares of this, because that's the emotion that retailers and individuals have when they own Safaricom, Equity Bank, and so on. So I think we cannot overcome the fact that everyone has a real estate project. You now have to say, yes, you have your project here, but I'm giving you an option to diversify. So you have housing, now do you have access to commercial? Do you have access to infrastructure assets? So I think it's something that will come eventually, but when you talk to the investors, you have to understand, even with the trustees, what they have and what they go for. I think REITs also have to be seen as a potential solution to some of the direct property holding challenges that pension schemes have and insurance companies as well have. They invested, they have these large land holdings, they have these large properties which are sitting on their balance sheet, they have huge capital charges, but they're not liquid. There's perhaps even a risk in terms of maybe they're single tenant owned buildings and so on. How can a REIT solve that problem? I think from a structuring perspective, the other thing I would say is, yes, you can set up a REIT, but practically, I would really say that you need to start with a vision to start with maybe 3-5 billion, but know how you're going to get to 10 billion very fast. Because if you get stuck at a low level, you might never grow, because fundamentally with a REIT, you're paying out 80% of your income. So how are you going to grow? You can only go through capital raise, so you have to be able to have unit holders who can give you that money, or anchor shareholders who can give you that money, or promoter who can give you that money. So if you only want to sell 25% and keep 75%, you have to know that you have to be able to fund 75% of any future acquisitions. So do you have that? The other option is using the units now as currency. So if you have properties that are attractive, can you give them units in exchange? So you as a promoter now, you're at 75%, are you willing to be diluted? And that's where we find challenges with promoters and issuers. They've not thought that far. So you come, you have your properties, maybe you're at 5 billion, you don't go anywhere because you don't want to be diluted, you don't want to raise capital, you can't. So I think we also have to have that vision in terms of REITs and be very practical and very realistic, that can you actually grow? If you don't want to grow or you cannot grow, then can you come together with different asset owners and have a REIT maybe that's 20 billion, there are 3-4 of you as key anchors, and then you can get like institutional and high net worth to come in there. And then maybe then from 30, you're now moving to 50. Can you really do that? Are you comfortable doing that? Or do you want to own 100%? And I think that's also something that we would have to overcome, and I think that's one of the greatest challenges in the REIT space as well. Thank you.
Fantastic. Before I close this panel, I know we've not heard from one key stakeholder, and I know who's currently been aggressively selling one of the REITs in the market. And with those remarks that Cynthia has given, I know there's quite a bit you can add on to fundraising and even having REITs coming back to the market to try and raise more money and to try and scale up. Because one of the key points she raises is that if your target is 3 billion, I mean, start small, but you need to know how you're going to scale up very, very quickly. So I think you can really shed some light in terms of those challenges and even the advantages and benefits that you've seen and what has worked in the market as you have actively been raising money. Yeah.
The way we see it, or at least the way I see it, it's a conversation that has been touched on, and there's one key item that we cannot run away from, no matter how we try and package it. And it's not a REIT problem issue, it's a risk asset issue. And it's the issue we've discussed about return, but then at the same time, not just return on its own, but risk. So the way I look at it is that as players in this space, and one of the key items that the toolkit is trying to solve is to remove some of the bottlenecks. First of all, understanding of what the process of raising capital should look like. Just have a snapshot of that even before you embark on it. Because when it comes to financial services, a lot of things is you need to internalize it, you need to think about it, and the more barriers you create for someone to internalize, then the bigger the challenge is. So the toolkit is looking to, first of all, resolve that hurdle. Let's have all information regarding raising capital through the REIT market in one place. Be it financial, be it legal, be it business strategy. Okay. But then even if you do that, then the next hurdle is the one for risk and return. How do we get all risky assets into the investor's portfolio? Yeah. Because currently, to be honest, and if I poll here, who has money where, because we all have capital, where does that capital sit?
Thank you very much. And I think we'll close on that note.